Hi, everybody. So many who will know me know I carry around with me a tiny little soapbox that I occasionally bring out, stand up on, and yell about the importance of the participation of strategic and corporate investors in the innovation ecosystem generally, and particularly in climate tech. And I think we got a killer panel. You guys can meander up. I'll borrow you as you come in to talk about how do we spur corporate Canadian venture capital. And I think there's sort of two themes that we'll cover. One is the participation of strategic investors in Canadian ventures, but also the participation of Canadian corporates in the ecosystem, sort of two dynamics. So before we kick off, I'm going to introduce our amazing panel in one quick sec. Any corporates in the room? And corporate, if you work for or part of an organization that has north of 100 million in revenue, raise your hand. I'm counting like maybe half a dozen. We're going to go with like 10. Okay, this is for you. Okay. So we'll cover a few things, but first I want to introduce who we're chatting with here today. And again, like ultimately the question that we're really trying to answer is how do we explore encouraging more corporate investment? Why does that matter? Why should we care? Why is this particularly impactful? Particularly given the nature of the problems that we are collectively trying to solve. So let me first intro who's here. So next to me, Peter MacArthur, VP and National Cleantech Lead at RBCX, as well as the founding chair of OCTIA, the Ontario Clean Technology Industry Associations, and arguably one of the most benevolent flag bearers for Canada's clean tech ecosystem. It's true, yeah. And the reason I moved to Ottawa, that's fine. Irene Yang, who's principal, I'm my order wrong here, Jesse Ju, CFO at InMotive, multiple past CFO roles, including organizations such as Stromcore, also raised around from a strategic investor recently. Irene Yang, principal at BASF Venture Capital, where she leads the investment practice across North America and previously worked at AMD and McKinsey. And Matt Stanley, who is a partner at BDC's Climate Tech Fund and previously was an investment manager at IKEA's corporate venture group. Qualified human beings to talk about a very important issue. Now, before we jump in with some questions, why don't we talk about some statistics? That's fun. I don't have a nice slide, which I usually like to preface with. So why are we here? Why does this matter? What's the impact? Okay, so 2022, there were over 2,600 corporate venture capital funds globally. That is a lot of organizations that were set up within large corporates to invest capital and engage in the innovation ecosystem. That's up 5 times since 2012. This aligned with a quarter of all venture capital rounds had a corporate investor, and 50% of the capital came from CVCs, so writing proportionately larger checks. Well, that means that they play a very important role, not only in early stage, but also in growth stage. More importantly, the Global Clean Tech Report indicated that 44% of all clean tech deals in 2021 had at least one corporate investor. So that's versus 25% in all tech, 44% in clean tech. So corporate investors and strategic investors play a really disproportionate role in this ecosystem. So this matters. It's capital, and as we're going to talk about, strategic value. In Canada, we've seen some of our best companies, top clean tech companies, secure meaningful capital from corporate ventures, notably including Ever, Econa, GHGSat, Svante, Carbon Engineering, and our friend eZinc. James is hiding out there somewhere. Hey, buddy. However, the vast majority of corporate participation in these venture rounds, and thus the strategic engagement that they provide, has not been from Canadian CVCs. While 25% of global VC rounds had a corporate VC, only 14% of Canadian rounds did. So underrepresented. And of the Canadian VC rounds that had a corporate investor, less than 25% of those were Canadian CVCs. So really lagging internationally. This holds true. There's a BCG report. Corporate investment as a share of private investment was 2.8 times higher in the US than in Canada, 5 times higher in Europe than in Canada, and 8 times higher in Asia Pacific than in Canada. So what gives? What is going on? This matters. There's checks being written. There's capital flowing. Canada, what are we doing? Why are we missing out on this opportunity? So in the vein of like lobbing really easy questions at my friend to my left here, I think it's really important that, there's encouraging signs, right? Capital is flowing into the Canadian ecosystem. We're going to hear some stories about why that matters from a strategic perspective. But where are the Canadian corporate investors? And why should we, as Canadians, and particularly those who are passionate about climate tech, care? Peter, where are they?
Well, they're there. So let's just start high level. Why do we care? So it's going to take $2 trillion for Canada to get to net zero. 2 trillion, 190 trillion for the world. That's going to take a lot of capital. Canada's government has recently announced $80 billion in investment tax credits and other solutions. We need that per year to 2050 to get us to net zero. Federal government can't do it on its own. Canada is miles away from meeting its GHG reduction targets for 2030, just 6 years and 1 month from now. Certainly there's corporate VCs in Canada, Brookfield, Natural Gas Innovation Fund, Fund 1 of Evoke, in essence a CVC for Suncor and Cenovus, TELUS Pollinator Fund, Power Sustainable, comes out of Power Corp. So they exist here, and there are others. Another set of stats beyond what you just provided there, Graham. RBC Economics reports that the Canadian venture capital in general put only 5% of investment towards cleantech companies in 2021 versus 14% globally. So we've got a general problem, and cleantech is particularly underrepresented relative to information technology among active funds focused on early seed or pre-seed funding stages. So there's lots of gaps. BCG, Boston Consulting Group, has a great report, some of which Graham just reported on. In June of 23, I highly recommend you take a look at it. Identified that out of 15 OECD countries, Canada ranked second to last in corporate R&D spend per capita. Is this because we have a branch plant economy? I don't know. I'm not an economist, but I've read elsewhere that 50% of the technologies we need to get to net zero exist, but 50% of them don't. So we need investment in innovation. We're not going to get there if we don't have any ownership of those technologies. So government of Canada can't do this alone. It probably won't do a good job just on its own. And Canada can't afford to take on the infinite amounts of government debt to get us there. Corporate venture capital not only has the ability to deploy meaningful amounts of capital into clean technologies, but also to modernize and make Canadian industry more globally competitive, and to pull through and distribute the technologies that are being developed. Also, when a CVC invests, it provides a proof point that there's real tech and that the market understands and sees the potential there. So there are some CVCs, we're underrepresented, now we're going to solve the problem.
Open up to the rest in terms of commentary, but I'll kind of lead this in one way is, so yes, there are Canadian CVCs. I think there's a lot of room to grow relative to our international peers. That lends to, the participation of a corporate venture and strategic, there's a commercialization element to that, right? We're sort of leading in the direction of that, provide some proof points. So if you're a Canadian company or a Canadian investor and you're looking at building a cap table, any problem with it just being international corporates? Like, why is that such a bad thing? Is that a challenge?
Maybe I'll go next. As you know, BSF has a large Canadian presence and also a large international presence. Very briefly in Canada, I would say we're a mid-sized corporate here with 1,200 employees and 10 sites across Canada. So in general, we need to innovate up and down the value chain and at early, mid, and late stages. And this is critical, and we try to do it. When I looked at our customer base in sectors like agriculture here in Canada, plastics value chain, circularity, home and personal care chemicals, pharma as examples. We think we're not doing enough, but certainly some of our customers and suppliers really need to do more. So this is just a start, yeah.
So maybe given, Irene, your role at BSF, and BSF, as I learned backstage, is started in 2001, your venture practice, so 20 plus years. I mean, that's like, you guys are OGs in the corporate venture space. And Matt, I'll come to you after this, is given your role at IKEA, what's the business case for a corporate to establish a dedicated venture arm? How does this make sense? And Irene, maybe we'll start with you just to kind of continue on that thought.
Well, there's a financial business case and there's a strategic business case. And you'll hear this a lot from CVCs, even though CVCs are organized very differently. As a startup, you need to inquire, first of all, if you're working with a CVC, how are they organized? The financial business case could be quite compelling. You can make a lot of relatively smaller bets in multiple technologies that are emerging, and additionally, learn, but also share knowledge, share access to market, potentially have a disruptive, adjacent, or complementary new business that some of our core competencies don't allow, be it hardware or software or materials tech. on the strategic side. And then on the financial side, we're sort of in the middle of that spectrum of CVCs. So we are absolutely metriced on financial return. And that could be, in our case, it's an evergreen fund, so we can reinvest those into new technologies. And then the softer part of the financial and the strategic, technical new markets would be the agile way of working. We encourage all of our business units, no matter what sector they're in, to work with startups, to open their minds. And once you do one or the other project, you could really be inspired by, number one, how fast they move, the startup, and the talent that comes in and the know-how that flows between the corporate and the startup. So those are some of the few benefits. Yeah.
Matt, from your experience at IKEA or BDC?
I mean, I think corporates set up CVC arms for different reasons. Some of it's set up because they want to have asset management. They want to diversify their portfolio. It comes through the treasury arm. They invest off their balance sheet. This can be it can be passive. It can be quite aggressive in terms of how they do it as well. Corporates also do LP investments into funds, and they also start to sometimes set up dedicated funds that directly invest in companies. There's a progression there in terms of how corporates start to engage in the ecosystem and how they start to manage their capital. I'd say in each of the scenarios, when Irene was talking about kind of strategic versus financial returns, there's different personas of how corporates engage. And so the ones that are really financially oriented and really kind of independent from the business, maybe not tied to the BU, are financial returns driven. The ones that are very strategically linked, so they're looking at the business units to tell them what the needs are, what they're trying to solve for, and the ones that are maybe more flexible in their return profile, much more strategically related. And it's important when you're talking to corporates to understand what type of, how the structure of the CVC is set up, what it's incentivized to do, and how does it flow into their overall innovation ecosystem? Because most of the time, this is not just deploying capital for the sake of deploying capital, it's deploying capital to create change. And that change can come in many different formats. But I think you need to understand why they set it up whenever you're engaging as a founder to the CVC, what value they can bring, how closely tied to the decision making is it on a business unit level, and what you can how do you work with them to be able to actually start to create systemic change either within your organization or for them to be able to create the returns they're trying to look for as well.
I'd like to understand, we're going to segue in terms of Jesse's perspective from venture, but maybe first, given the spectrum of different types of CVCs, right? Like most financial venture capital funds are set up similarly. You can Google them, you can find them, you know who to talk to, they're at conferences, you can shake their hands. Access to corporate venture capital and strategic investors is a whole other can of worms depending on how they're set up. And maybe just to pull on the thread, Matt, that you just mentioned in terms of if it's just a corporate development group investing off their balance sheet, kind of onesie-twosie, versus like a set-up 20-year dedicated venture practice, and I guess how that translates into accessibility in the context of a corporate creating a viable business case that's actually scalable, and then I'll transition that into Jesse's perspective. Yeah.
Look, I mean, I think I don't know if this is exactly, but like I look at it from most corporates are all trying to have similar challenges or similar needs in terms of new product development, new material development, new supply chain design. They're all trying to engage, and corporates have the challenge of them is you don't really know who you're speaking with at times when you're actually talking to a corporate. Is it the CVC head? Is it a business unit lead? Is it a innovation scout? Where do they fit within the matrix? There are matrices within most corporates. Who do you influence, and how do you kind of work your way through the corporate ladder to be able to figure out who you actually play with? I think it's easier, you should really just proactively have discussions across any corporate of like who's investing, who's responsible for what, how does this fit into your innovation landscape, and start to kind of figure out, like you would with any customer, figure out how do you actually start to understand the corporate, understand the needs they're solving for, and figure out where do you fit within that matrix. Because until you get to that point, you're probably not going to be able to have much pull within the organization. So you really need to do your homework up front to figure out how do you fit and where do you start to play.
Maybe transitioning from the venture perspective, and Jesse, maybe you can give a little background in terms of a little bit about InMotive and kind of your fundraising journey, but I'd love to understand how you came about finding, working with, and ultimately raising capital from Suzuki in the case of InMotive.
Yeah, so InMotive, we are R&D company focused on creating multi-speed transmission for full battery EV. And then we recently got the investment from Suzuki Venture Fund so it's a Suzuki CVC. To echo Matt's comment about really understand the structure of the corporation, as well as how the venture fund for Suzuki is set up, is very crucial during this process. And then to add on that, we also need to have a basically a champion within Suzuki to push our investment. So if with no individual person within Suzuki help us, then we wouldn't be here. So find that person really passionate about your technology, really passionate about your team, and then can be the advocate when things go difficult. That's really important.
Just to follow up with Jesse, I think one of the things that, so having a business champion is both, I'd say, super critical on the venture side as well as within the business. One of the things that is very difficult, though, is typically with it, if we're doing a seed or a Series A investment as a CVC, by the time that technology is ready to be deployed within the corporate, the BU champion may have moved on to something else. And so it's not just one champion, you need multiple champions bringing your technology into the business, anchoring it with multiple levels so that whoever moves, you're still there. And if you don't have that anchoring, it can be really disruptive for the entrepreneur because you have spent 2 years building a relationship with some person who moved into another department is no longer responsible. And I think that also goes with the venture arms as well. If you don't have dedicated venture arms with dedicated investment professionals that are there for the long haul, they may kind of float in and out from the business units, which can be hugely accretive to the business and the VC, but it can be detrimental to the entrepreneur if they move on before the project starts to consummate or get anchored within the business.
Yeah, and I think that's a good point around the stage. The way we set up our VC arm is slightly earlier stage than, let's say, pilot ready on average. We're a late seed, Series A, kind of classical investor, and Series B. On average, our business units and our sites are probably a Series B onward in terms of real readiness to engage. It doesn't mean that they wouldn't love our VC arm to keep startups on the radar. In fact, they're quite supportive of us being that risky investment vehicle and keeping a close eye and obviously sharing in-kind know-how. But a lot of them may not be ready to work together as yet. And that's fine. And that's a bit how we organize. But not every CVC is the same. Some CVCs will say, unless I do a project with you now, I won't even enter due diligence. So that's also a watch out. Then it would lend itself to you need to get funding elsewhere, develop your technology, ramp it with other customers, and then maybe I'm interested in being customer number 5. That's very different, right? I would say even BSF's been doing CVC for a long time. Do our BUs always want to be customer number 1? No, absolutely not. So we got to find the right champions also, and that's our role internally, who are a little bit more risk-taking, who might have a budget to give some things a try, and those technologies really have to be disruptive. Yeah. Sorry.
I want to pull on a thread there a little bit. So one of the themes that we're sort of covering, generally speaking, is accessing, right? Like getting access to a corporate venture investor can be more difficult if they don't have an Irene, right? Like everyone knows Irene. Irene's been around. And I think if you don't have access to a human being who can be that advocate, you're left to navigate that machine on your own. And I compare it to actually, Peter, I'd like your perspective on this, is a lot of the earlier stage companies that we spend time with, myself when I was at Silicon Valley Bank, commercializing as an early stage company is really hard because who are you selling to? You got to navigate an organization, figure out who you're talking to. That's really hard. When you're doing that and also trying to raise capital, it's even harder. And Peter, you obviously had an advocate for clean tech, broadly speaking. Do you have conversations with companies in your network as it relates to accessing, like, who are the people I'm supposed to talk to? Who is the human being who I'm sending an email to and having a phone call to? Because it's very opaque in many cases, absent a very clearly dedicated venture practice.
It's a huge challenge for all entrepreneurs to find the right person to talk to at a venture capital firm or a corporate client. And sometimes our clients are not using their time wisely, but they're just spraying and praying. And to have partners who can help you get in and figure out who the right party is invaluable. So if you have a CVC behind you, or you have informed parties, you're working with MaRS and they've got good connections to the right parties, it makes a gigantic difference. The spray and pray thing, time is the most valuable commodity you've got as a young entrepreneur, and you don't have time to waste. So the more pointed you can be, the better. But it's tough. It's tough to find out who the right person is to talk to at Royal Bank. That's me, by the way, for your clean tech. but it is. It's, it's a huge organization. It depends on what your needs are.
The relevance, I think, and the theme here is, and I'll sort of pivot away from the what wasn't it hard, and talk about some of the successes. But I think there's an important narrative here, which is if a corporation's genuinely interested in engaging in the innovation ecosystem, which I think is critical for the Canadian economy to consider, if our Canadian companies are actually actively engaging in this ecosystem to remain competitive on a global scale, there's a way to set up that machine so it's accessible. Because if you're not easy to access from ventures, whether it's because you're writing a check or simply you're a willing, enabling customer, then it's just becoming harder and harder. And those points of friction, to Peter's point, small teams of ventures who have 1,000 things to juggle don't have necessarily the resources to navigate your machine for 18 months. So it's really important, I think, to have established organizations that can facilitate those relationships and can facilitate engagement. And I think this is where we've seen such a disproportionate participation from corporate venture organizations that are set up institutionally for success, as opposed to onesie-twosie off the balance sheet and good luck finding my email. Now the flip side, because there's lots of positive case studies of Canadian companies who have had an immense amount of success engaging with strategic investors, not just putting capital on the balance sheet, but activating those relationships. Jesse, I was wondering if you could talk a little bit about how that's played out with Suzuki and sort of the value and how you've engaged with them to extract value beyond, again, just the capital on the balance sheet.
Yeah, I think the conversation start with align vision and then goal in the long term and short term. I think initially they really kind of respect our mindset about innovate. So EV is a sector you have to do something very differently over time, and we have been doing this for a couple of years and then keeping working on it. So they respect the innovation from us, and then we align that vision. Like Suzuki is also want to create an innovative environment for that company. And from there, basically, the conversation starts. And we've been working with, so Suzuki's corporate venture fund has a different structure. They have an arm in California, and then also they have a corporate in Japan. So we have to kind of keep both sides communicated. So from process perspective, once you align the vision, then you basically need to figure out, okay, how do I mingle with all these parties involved in this whole transaction? Because it's not just about venture, it's also about corporate investing, and also about business, and also about their network, their thinking. So you basically need to kind of fully engage with that corporation about what they're thinking, why they want to invest with you, as well as what they want, what we want from them. I think that's basically the process.
Yeah, I'd like to build on that. One of the things that we see from a startup leadership perspective that we like a lot, let's say the CEO or the co-founder, is customer focus. Why do I say that in the lens of a CVC discussion? Because if you know how to navigate a complex customer, then somewhere in the management team of that startup, you'll have a sense how to navigate a CVC, either for partnership and or for investment. And we like to see that. It can be an advisor at the beginning, doesn't have to be one of the founding members. And I think that already shows, however they show up. I mean, for us, we're fortunate in that we get leads via Germany because some of our critical scouting positions might not sit here even in the region. We get leads from part-time technology scouts that are in the market showing up at random conferences. It really can come from anywhere. We're trying to find a good way to manage that. But I think that know-how shows pretty quickly in the first pitch, right? Then it's about, okay, not just potential investment, but I'd be more comfortable introducing you to a business unit now or in the future because I'm comfortable not needing to be a part of that day to day, right? Because you'll have a sense of the energy it takes. You would also tell your investors more realistic timelines. If you've done a pilot, it really might not be 1 year before you sign that procurement contract. And just having a good sense of that is, to me, venture investable as well. And then, secondly, I just wanted to throw in there, just to complement the examples of Canadian corporates. Outside of the very few investments we do make, we make about 10 globally, so not a ton. There's so many other startups that we could work with. In the Canadian context, We have an Alberta project, circular plastics recycling, with Layfield, London Drugs, Nova Chemicals, et cetera. None of them, as far as I know, have CVC arms, but they're engaging in a project which involved, in that example, a California-based startup. Another example here in the Canadian context, earlier stage, would be Indigenous Beauty Boot Camp. So we run an accelerator for cosmetics. We provide ingredients into cosmetics, along with Brentag Canada, Seneca College, run by Stitch Crew. So our colleagues are trying to do more, but I think it gives also the other corporate players in Canada a flavor for engaging. And then maybe over time, they'll become an LP in a fund, or co-invest with us, or do the onesie-twosies that they're not even doing today.
I think, when engaging with CVCs or in venture investment arms at whatever, kind of however you define them, take the same needs analysis that you would do for a customer or into a corporate. And one of the things that I think, specifically tying it back to climate, most corporates are pretty clear on what their targets are. Like the ones that you want to be engaging with right now, they're vocal about it, they're setting their objectives, they're out there communicating what they're trying to accomplish. They don't know how they're getting there, most of them. And so if you can start to really unpack what you can solve for them as what's their core challenge now or a few years from now, and how your technology can start to address some of the fundamental challenges, like focus on the problem they are addressing and figure out how do you collaborate with them. And I think also, what do you want from them? Because capital is only one part of this conversation. And I think access, to Graham's point in the beginning, is important, but access in the context of like, do you want technical know-how? Do you want them to help you de-risk your technology? Do you want them as a partner? To be fair, a partner is maybe more valuable to you where you can get VC capital from somewhere else. So understand how they can engage, understand how you can work with them, and what problems you're trying to solve for them, because then they will get sticky. If you're just trying to get money out of them and then trying to figure out how can you support them later on, it's not quite the same angle. Most corporates want to solve a problem. Even the venture arms want to solve a problem for the corporate, because that, at some level, is what they're all working against. And so figure out, does your technology solve a problem, then figure out who you need to talk to get access to that.
A few themes I want to pull on here is there's responsibilities in this engagement between both the CVC and the venture. I think the work, to your point, from a venture perspective is what do I need out of this relationship? And I'll call it an anecdote, because I was chatting with our friend James Adizek before, and he talks highly of his experience with Toyota, who came in and spent a lot of time helping them meaningfully optimize their operations.
Yeah.
Whether or not that was the intent of the investment or the relationship, doesn't matter. They're adding meaningful material value in terms of supporting the scalable operations. And I think that's different than saying, oh my God, I need a customer so bad, and I hope if you write a check, you might also buy my thing. I think one of the important themes is just defining success. And I'm going to pull on the commercialization theme specifically, because again, there's a lot of different ways that corporates and strategics can add value to ventures, and that it can be highly impactful. One of the comparative challenges between the Canadian and American, or let's call the American market specifically, is that pathways to commercialization in Canada have historically been far more challenging. It's why most Canadian tech startups, and particularly climate tech startups, are born exporters, because your market, I know the next panel's on the IRA, so I'll leave that one aside for a second, is probably not as much in Canada. I think one of the contributing factors is when you've got a corporate ecosystem which may not be as actively participating as an investor, which is obviously the biggest way to show commitment, it's kind of harder to find them as customers. They're not sort of as vested. So I wanted to maybe just pull in the thread of, what does success look like when there's a CVC at the table and a company who wants to leverage those relationships for the purposes of early commercialization, which again is critical in continued access to capital and demonstration of technology. Maybe I'll start with you, because we chatted a little about this previously. So just pull on that thread a little.
Each individual investment, each individual company is unique. I think it goes back to what problem are you solving for them, but how could they potentially support you? I won't go into kind of e-zinc with Toyota, but like there's elements of how do you help to lower manufacturing costs? How do you help to streamline your operations? How do you learn from them to be able to commercialize or bring your product to market in a different channel? Each individual, whatever you bring a CVC in, and usually they're part of a constellation of investors that you're bringing to the table, hopefully. Sometimes they're the lead, sometimes they're the participant, but like, write that guiding document in the beginning of like, what are you mutually beneficial? How are you mutually benefiting each other? Capital is just is a lubricant on this one, but at the end of the day, like, what's going to keep the sticky relationship together? And you may want something from them, and can they give that to you, and how are they going to give that to you? And make sure it's documented in a way that, like, this is what we're expecting, because the other VCs around the table will also look to that CVC to say, kind of like, are you supporting the company the way we thought you would? And if you're not, then they might call you out, but the company can also say, like, this is why we want you here, and like be very vocal about that. And so it's a guiding document, it's a mandate that you set forth when you actually bring a CVC in. And I think it's a great kind of exercise to have whenever you do that.
I think some of our, if I could chime in there, some of our more successful portfolio company engagements are those where it doesn't have to be pre-investment, but over time, our business units engage. For example, being very clear, sometimes with numbers and pricing, what incumbent solution do you have to displace to be successful? Another example would be the cost curve assumptions that might come, especially if we're talking cleantech. Are those reasonable? In other words, if you're using solar panel cost curve as an analogy to a totally different climate technology, is it applicable? These sorts of early in-kind conversations, I'd say we'd love to have. For us, it's not a criteria that engagement has to happen before the investment, but a more successful portfolio company over time would have a deep sharing of knowledge at minimum. Ideally, really have either a go-to-market, a joint development, and a really close partnership, that it's win-win. I might want to preface, and this comes up a lot because we're a CVC, that we actually don't like exclusivities at all as investors, even with us. And sometimes we try to stop our business unit from asking for them. They still try. But we also always tell the entrepreneur, only sign it if you can scope it regionally, by product, some time-bound thing, and if it's win-win for you, right? Otherwise, it's not a great investment. We could partner with anyone, and we do, but that's outside of where we invest. Yeah.
You touched on something, and Jesse, I was hoping you maybe can cover this a little bit. In addition to the theme of how to commercialize, or how having Suzuki, in your case, at the table supports the commercialization journey, but specifically some of the competitive dynamics of having one potential customer as an investor, potentially on the board, and how that may play out as you think about broader growth strategy.
I think it's the common goal is to get the technology massively adopted by the market. So even if they are investor and also their customer, they still want this technology to be in the market, not to be exclusive to Suzuki. They want to be shared with other OEM. And also, I believe CVC is a kind of a lifetime partner to a corporation once they invested. They will share their network, they will share their knowledge, but they're also taking the risk with you. So that risk is also the risk the company is taking. So I don't think, like in our case, Suzuki want us to work with as many OEM as possible because it's actually, as an investor, it's good for them too. But from board seat or control level, we don't feel other OEM feel like offended or intimidated by this because the common goal is we want to get this technology to the market as much as possible. So to summarize, the goal and the mission need to be aligned before you're talking to the corporation or get the corporation investing you in the company.
I think just building on that for a sec, because one of the things that I think at times entrepreneurs see corporate venture as a pathway to an exit or as a pathway to an acquisition. And that can happen, and that does happen. But I think more often than not, you're seeing these days is just desire to engage and desire to participate and to collaborate. And I don't think that you should see most CVCs as a pathway to an exit for the company. If it happens, it happens. It might gain you better access, build a deeper relationship, a long-term commitment. But I think, but sometimes corporates can also be a little bit schizophrenic in terms of their behaviors, because some BUs will be like, we'd like to own this. And you're like, you can't. You have a 5% equity stake in this company. And so like understand the tendencies of are they an active acquirer, and are they doing this to be able to do kind of innovation scouting and then look to buy the tech, or are they actually just want to engage? And make sure you split economics and the rationale for investment with the potential exit scenarios that you might face in the future, and don't limit yourself to a single potential exit or acquirer, by who you bring on the cap table. Make sure they don't have the rights, if you can avoid it, to avoid that situation from occurring, or that limits the ability for other VCs or other investors to look at that company, because then you're sub-optimizing your potential outcomes.
Given Peter's phone rang while he was on a panel and didn't mute it, I'm going to ask him a really easy question. Peter, why aren't Canadian banks doing more in this sector? Well, so interesting stat, though. I know I got a real question to a degree. Of CVCs in Canada, 55% of the participation has been from financial institutions. Some of this LP, some of this direct. Compare that to the US, that number is about 30%, and compare that to Europe, that number is pretty well 0%. And so FIs, and particularly banks, play a disproportionate role in CVC, such as it is. So I guess, why is that, and what is the role of Canadian banks, RBCX as a good example, in this ecosystem?
New phones. Sorry, I don't know how to turn it off yet.
Ageism.
So banks are generally senior secured lenders, lending against positive cash flow. That's sort of our core competency. Equity investing is a very different business. Certainly the Canadian banks have investing expertise, but this expertise is generally focused on established businesses and technologies. That's not venture investing. We do venture capital investing, venture debt through RBCX, but that's off of the venture capital that's been invested that we leverage and play off of. Almost all the Canadian banks had VC arms in the 1990s. Almost none of them did by the 2000s. Those were not successful initiatives. Investing in clean tech is particularly tough. It's often deep tech, highly technical, relying on core engineering and chemical expertise. These are not core competencies for bankers. However, Canadian banks have begun investing through professional venture capital firms, acting as limited partners, like you were saying there, Graham, and letting the venture investing experts exploit their knowledge and their access to hard tech expertise to make smart investments. I don't know the whole landscape, but a little bit of research. CIBC in 2021 committed $100 million to LP climate investing. 2 years ago, Royal Bank had $500,000 in committed capital to one clean tech venture fund. They might be in the room. Today, we have committed $140 million to 5 clean tech venture capital firms, and we're not done. We're not talking trillions, but anyway, $140 million is something. It's a huge improvement. HSBC globally has committed $1 billion to climate investing. Are those numbers enough? Clearly not. I would like to think we're going to see additional investment by the financial sector in climate work. It's so relevant to all the communities that all the financial institutions serve. You can't get away from it. So I'm going to go a place you might not have expected me to go and just say there are places, and this is sort of something Irene prodded me on. You know, what's the role of the fintech solutions that can play in here? And is there a financial role in climate that is more aligned with the bank's core competency? So there's, you know, a new source of capital, and we've talked about it a bit, carbon removals yesterday, carbon offsets. Can that be something that the financial community can participate in and provide value for? So I'll give you an example. Recently, Royal Bank, at my urging over a number of years, but we just made a purchase of 1,500 tons of offsets. 1,000 of those tons are going to offset our own footprint. 500 of them are being used for corporate clients of ours that want to use those offsets. So these are offsets that Royal Bank has used its own due diligence on, and it's, you know, it's not a straightforward market. It's complex. It's not for the faint of heart. But we've used our due diligence and bought them for ourselves. We think they're good and credible, but we're also buying them for our clients. So we set up a market solutions group, environmental market solutions group, that's buying offsets not just for ourselves but for others, and we're exploiting an investment we made in Clear Blue Markets this year to draw on their expertise to make sure we're even more informed than we were. And I see offsets as a potential way for corporates, banks, to play a more active role in the clean tech community.
We have a flashing red light, but I'm going to give Tyler a conniption if he's listening. That's okay. We're going to go a little over. Because this poll is relevant because it's really uncertain. It's sort of split here, isn't it? People just seem not sure about the answer. So maybe just a quick rapid fire from everyone on the poll is, so if Canadian corporates are not doing enough to invest in adopting Canadian climate solutions, and I would extend that to just generally participating in this ecosystem, each of you get the one thing you think either would help that happen or you would just love to see happen. So rapid fire, Matt. 8 seconds.
Understand the net zero challenges you are facing. Invest in the technology companies that are your back. Figure out how you work with them. Evolve your business model or evolve your investing model over time.
I say you need certain roles in Canada, such as strategic, innovation, product management, product marketing. These roles have to sit in Canada and ideally be incentivized, or the pilots incentivized, with government funding, which is abound, but at different parts of the ecosystem.
Yeah, this is a tough one for me. I would say look at your potential clients and then to see whether there's a way you can work with that corporation and then get funded.
I'll say you need a drive for innovation within Canada. We've got to own this, and we've got to take it home. And so you just can't look at other people to do it. You've got to be willing to take some risks, and it's a bit of a cultural shift for Canada.
I'll use this as a wrap-up comment. There was roughly 10 sort of corporates in the room that raised their hand. Show up, be present. This is like step one, as one of the themes is it's impossible to get access to a customer or to an investor if you can't find them. So kudos to the 10 that are here. Be here, you have a role as a champion. All 4 of the individuals here are champions within their own organization to help companies succeed. And so tell your colleagues, build this championship within your organization, because it's totally irrelevant to do this on a whiteboard on the 30th floor of some office building on Bay Street. It's show up in these rooms and be present. So that's the call to action. Thank you, panel. Thank you, everybody.